Well, good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Tonight is my 999th show, and it's a real pleasure of mine to welcome back Mark Borkowski, the president, founder of Mercantile Mergers and Acquisitions, to talk about the M&A marketplace. And we're probably going to touch on real estate market and M&A market and financial market and general markets in addition. But Mark has been a friend of mine, an associate, and a real supporter of my radio show. And so I thought it would be completely appropriate to have him here for my 999th show. Unbelievable.
Wow.
Mark Borkowski, welcome back.
Thank you, Brian. Pleasure to be here.
So
let's talk M&A.
Let's talk M&A. So you were saying before we got on is that there's a lot of money, a lot of dry powder, but not a lot of deals. Is that correct?
That is absolutely correct. In 2019, the American Venture Capital and Private Equity Association, of which I'm a member, and the Canadian Private Equity and Venture Capital Association tabulated that there was about $1.1 trillion of what they refer to as dry powder. That's capital that's not been absorbed into the M&A markets. COVID hit. You paid your pension obligations, your insurance obligations. These organizations have to put money out to get a return. Canada Pension. As of May this year, that number's gone up to $2.3 trillion of dry powder. And from the institutional perspective, nothing to acquire. Institutions want to invest in larger projects. So that separates a lot of the traditional M&A. Private equity firms, the institutional capital, larger organizations want to acquire companies that do at least $2 million of what we refer to as EBITDA profit, 2 and up. However, the vast majority of the Canadian American market are companies way under that level. Companies that are probably doing $500,000 of EBITDA profit. Owners who've been in business for 40, 50, 60 years that don't know how to approach this. This is not real estate. Doing a transaction, selling a business is a much more complicated process. And so many of these individuals who hold real estate properties, who've sold real estate, approach it that way. So it all starts with if somebody's legitimately contemplating a sale, doing a valuation. There are valuators who will charge $4,500 to do a valuation. If it's legitimate, we will do it for free. It takes 4 hours. We will sit together. We'll sign a non-disclosure document. If there's a legitimately good opportunity, we'd like to express our opinion. Problem is that many of these people have high expectations, just like in real estate. So in those cases, you have to throw them back into the sea. Come back in a year or two. What we're seeing, though, is that a lot of these companies are being run by individuals well into their 70s and, believe it or not, in their 80s. So at some point, there has to be a transition. But not yet.
In the real estate business, what's happened is with interest rate increases, cap rates, capitalization rates for the public real estate investment trusts, the REITs, have gone up consistent with the increase in interest rates. But in the private real estate marketplace, we're primarily talking about commercial, so office, retail, residential, rentals, et cetera. So where you're receiving an income. I'm not talking now about principal residences or condominiums that are for investment purposes necessarily, but every other sort of sector of the real estate business. Private market values have not gone down and cap rates have not gone up, consistent with the increase in interest rates. And what people say is that vendors' expectations are the same as they were before the run-up in interest rates, but buyers' expectations have had values go down consistent with interest rates, and so there's this massive bid-ask spread. What about in your sector? Has that happened as well?
No, I mean, valuations are holding firm. In our business, in the M&A business, organizations look at the fact that they can get a return on their equity and investment. Number two, they're looking at synergies that are created. If they're a strategic buyer, what benefits do this company that I've acquired bring to my organization? So we have not seen valuations in any way, shape, or drop. With the influx of additional capital available from the banks and the institutions, it's still a seller's market. Sellers who have a legitimately good business, who will follow the process will get a high valuation. Many sellers, unfortunately, are being contacted by a flurry of individuals. There's, again, an incredible amount of buyers out there who've been told, go out and find a deal. They're called search funders. The universities are telling all their students, go out and find a deal. Somebody will fund it. Some company owner will turn his business over to you for vendor take-back notes, for earnouts. Well, not necessarily. If they follow the process and engage a professional advisor, we will reach out to a sea of a large number of potential buyers that will bring a real deal. These individuals that these companies that get contacted by private individuals, most of these individuals want to buy them with what we refer to as their money. They try to do leverage buyouts. And owners don't have to sell to somebody that's going to load their company up with a lot of debt, give them a lot of vendor take-back notes or earnouts. Owners who are cashing out today seem to be older than the owners that were selling out pre-COVID. Again, we're dealing with a lot of guys in their people in their 70s and 80s that don't want to wait for long payouts. So they want a lot of cash up front. The Canadian government came up with some new legislation. It's absolutely toothless. Anthony Lofreda, who's a senator, ex-banker, very respected guy, said, look, these companies should be transitioned with a share transaction. Companies have to sell shares because company owners, each owner gets $950,000 technically tax-free if you sell shares. So if there's 2 or 3 shareholders in a smaller transaction, that's technically a tax-free deal. So the government said, look, in order to make this easier, there's a 5-year payout on a share transaction. Tell you what, we'll extend it to 10 years. Well, do you think some owner who's 72 years of age wants to be paid over 10 years tax-free? No. They want to be paid out over a shorter time period. So what we're seeing in the market today are company sellers at all levels that would rather take more cash than a lot of the promises of earnouts, which means if come, or vendor take-back notes. However, there are a lot of buyers out there. Unfortunately, a lot of them want to buy companies with, as we say, the owner's money, and owners don't have to sell. So it takes a longer process to sell a business, but there is capital out there and the right buyers are out there. We go find them.
It's very surprising to me that you say that it's such a seller's marketplace. I would have thought the opposite, and certainly in real estate, as you know, I'm involved in. It is not a seller's marketplace, no. Part of the reason why is that, as I've mentioned, valuation expectations are still too high and haven't adjusted for the marketplace. Number two, what I'm told, and I would have thought this was applicable in real estate as well as in your sectors, is that a lot of institutional money is on the sidelines, and they're on the sidelines because they're overweight real estate and alternative investments because the stock market's gone down. They've got criteria of how much they can invest in real estate and alternative investments, which typically ends up being your private equity kind of things. And so therefore, while they don't want to sell, they're forced to sell just to make sure that they're inside of their ratios, 20% or so allocated to real estate and alternative investments. And then finally, there's a big concern about commercial debt. There's a backup with debt financing. I had 2 banks just this week on commercial deals increase their spreads and decrease their leverage terms, such the amount of money that they were willing.
Canadian banks,
the amount of money that they were willing to lend against value had gone down, and it is as if in the last 2 weeks, frankly, the market appetite and attitude has changed. People are more skittish. You don't see that?
Not in our business. I mean, there is a shortage of companies to buy. I mean, there are probably listed professionally a little over 400 people that do mergers and acquisitions in Canada. At some of the smaller real estate offices in Oakville or Mississauga, there's 400 agents working out of a small office. So as we reach out to my colleagues, there is a very limited number of companies to acquire. I mean, we're finding that there's all this capital. We're encouraged by capital approaching us. I mean, we get calls every week saying, hey, we're visiting from Atlanta. We're a private equity firm. We'd like to meet in Toronto. What are you working on? Not much. So we're all reaching out to these company owners who don't seem to be ready to sell or not willing to sell. I think it starts with the fact that they have no idea of how to deal in this process or what the value of their business is. So to help them, if they're legitimate, in 3 to 4 hours, we can do a very hard valuation and say, either you're really a seller, and here's what a deal might look like, or carry on. Management buyouts are back. Let me tell you, many of these second in command, when you talk to these company owners that have been in business and they got 30, 40, 80, 60 people, they always have a second in command. Many of these individuals second in command, when this guy's taking 3 months off to go to Florida or Arizona, are running the business, those individuals usually don't have the wherewithal, but they have some capital. There are individuals out there that would love to back those individuals to acquire these businesses. Let me tell you, private businesses make a lot of money. Tax benefits for private company owners, Brian, are significantly better than anybody in real estate. And you know that. I mean, using holding companies, looking at tax rates, bonusing out, dividending out, being a private business owner is the only way to build net worth. Yes, they've done it in real estate, but let me tell you, private business owners make a good living if they have a good business and they've kept their debt levels down. Guys that are doing $2, $3, $4 million in revenue, considered to be small businesses. A guy making $4 million in revenue might be taking out $400,000, $500,000 before tax, and they look normal. So they're out there, and many of them are up in age. They don't have any kind of family or any other transition, so they're stuck and they carry on. However, they're out there. We can't get to them. Reason being, probably in real estate, you can set a valuation. You get somebody come out and say, based on the criteria you've given me, the valuation is here. It's not that easy with private businesses.
I don't think it's that easy in real estate either. Anyway, we're going to take a break.
It isn't.
Messages and come back with Mark Borkowski talking about the private equity, the mergers and acquisitions, the financing, and just the general economic marketplace in just 2 minutes. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960, my 999th show on Saga 960. And it's a real pleasure of mine to invite back Mark Borkowski, who's the president of Mercantile M&A, a gentleman that I've interviewed a few times. And Mark, you've been a real supporter, and I appreciate that.
Thank you.
Introducing me to a couple of different of your clients and friends and associates, people that you think are worthy of an interview on the show. And I try to bring good political commentary and good business and economic commentary to my show. So I really appreciate the assistance that you provided and the introductions that you provided. So thank you for that.
Thank you, Brian.
Thank you. I'm surprised, frankly, with your comments. When you think about how interest rates should move, how interest rates have moved, which is some of the biggest changes in interest rates that you and I have seen in our lifetime since at least 1980, when we had short-term interest rates up in the high teens. But other than that, this has been an incredible movement in interest rates. Typically, one would think that as interest rates move, cap rates move. Similarly, and valuations go down in the opposite direction, and price earnings multiples should similarly, go up with go down in reciprocal kind of relation to interest rates, and valuations go down. And we have seen some stock market declines, and EBITDA multiples should also go down, and valuations go down. And what you're saying is that you haven't seen valuations go down and EBITDA multiples have not gone down. Lots of us have taken first-year business school classes or economics classes, and you think about the cost of capital, the weighted average cost of capital. Well, the cost of debt has gone up, and the cost of equity is supposed to be a premium on top of the risk-free rate. The risk-free rate has gone up, and so therefore one would think that the cost of equity has gone up and people's returns have gone up. And just to put it simplistically, if you can get 6 or 7% on a money market fund or on a Government of Canada bond or something like that, versus the 2% or 3% you were getting a couple of years ago, one would think that you're demanding a lot more. On a mortgage fund today, you can get 9%, 10%, just holding mortgages. So why have valuations not gone down? Why have EBITDA multiples not gone down?
I'm not interested in 9 or 10%. Return on equity in private businesses are 25 to 30% return on equity. Take a look at these private companies operating on their own. They have some debt. Return on their equity on the retained earnings could be 25 to 30%. These are great investment opportunities. Real estate, we know what cap rates are. They're very defined.
So you're saying that when you're getting 25 to 30%, even if interest rates go up, you're still looking for 25 to 30%. You're not looking for 30 to 35%.
So you modify it a little. So suddenly your expectations go down to 20 or 22%. Return, well, we should do a case study to take a couple of financial statements, no names, and walk through simply and say, what kind of return on equity is this business owner getting? An average company under $1 million of EBITDA or less probably is earning 20, 25 or more percent return on equity.
If they were earning that before the interest rate increases and they've still got the same amount of debt, their interest bill has gone up appreciably. So the return on equity has got to have gone down by definition.
It's gone down, but still, I mean, we're talking about from 30 to 26 to 24, as opposed to your interest rates of 9% in some mortgage fund. It's still a better investment at the end of the day. So smart money, of course, is chasing private businesses to invest in private businesses. But again, it's not like running a plaza where you've got a property manager. If you're running a company that's manufacturing nuts and bolts, you need someone from the industry or understanding of that business to run the business. However, private business owners are getting 25, 30 plus return on equity. Property owners are getting what, Brian? Give me an average cap rate of, say, a commercial property.
An average cap rate of a commercial property, industrial or good retail, in the 5% range. Something more, in the 8% range if it's in a suburban, rural tertiary marketplace, etc.
So, 25, 8. A lot of opportunities in private business. That's why private equity.
Oh, okay, but you're talking about return on equity. So those cap rates would be the return on capital. So that's the
correct. Yes.
So that's the return. Correct. You leverage it up. And again, you come back to, and I'd be interested in what's happened in your marketplace, but in the real estate marketplace, bankers used to be lending 65, 75, 85% against value. Today, as I mentioned earlier, all those bankers are lending less money against your value, maybe 50%. And it's more so in the United States. And we've talked about this in the past. I think there's a lot of concerns about commercial real estate, particularly in the United States, particularly in China, but then in the United States, and such that, I had a conversation with one banker who said he'd lend 40% against value. And that's not because he says I'm lending less against value. It's because I think your value is wrong and the values are coming down. And that he's also thinking about debt service coverage. And because the interest rate has gone up, you've got to lend less money to get the same debt service coverage ratio.
Absolutely. However, most of the banks in North America are overweight in funding real estate. I think that's pretty well known. They're overweight in public stock. The money seems to be trending right now, moving into private equity. Private equity invests in private businesses. They grow private businesses, they provide debt, they provide equity, they acquire. So the greatest returns for institutions, all public information, US, Canada, right now, greatest returns for institutions, they're moving a lot of their portfolio into private equity. It's up substantially. Private equity is the place to be. Private equity invests in private business. Private business gets better returns than any real estate investment today, in my opinion.
Well, you may be right. I think that people have felt more comfortable in the past, and banks have felt certainly more comfortable in the past in lending to and investing in real estate because the asset values are there, and they continue to go up. Appreciation is the income on an annual basis is more steady and more secure, and the asset base is there. And that's why banks particularly have been willing to lend a lot more money against real estate versus the volatility in private businesses where you could have a pandemic, you could have a recession, you could have competition, you could have so many different things. Such that your risk of volatility in a typical private company has got to be order of magnitudes higher than
it's
in real estate.
significantly greater. I agree. You've got a shopping plaza. It's been funded. Bank stands behind. You're collecting rent checks. You're paying your mortgage. You're getting your return. There is a lot of volatility in private business. Competitor comes into the market. Key employee leaves the organization. But overall, a well-managed business provides a much, much better return to any investor than any real estate investment, in my opinion. But, that's the market I work in.
Yeah, for sure. Understood. So, you think about all these people that you've said are in their 70s and their 80s, and they've been running businesses for, 30, 40 years?
40, 50.
And they're looking to get out.
Yes.
They're looking to monetize their investment. But they're not going to sell at a price that will allow someone else to earn a 25% return on equity, will they?
Why not? Look, we do a valuation based on what we refer to as the normalization of income. So we've come up with a valuation. Look, the capital that they're going to invest in are going to get the same return that the investors receive in some fashion or other. The issue today with many of these owners who are up in age is how much cash can they get up front? Cash equity is expensive. So there's got to be a balance in terms of how the purchase price is structured. Most of these buyers are trying to do a highly leveraged transaction. In other words, acquire the business and load the company with debt. And owners say, look, I don't want you to load my company up with a lot of debt because it's going to restrict the growth going forward because you're going to be servicing a lot of debt along the way. And my payout, if I'm taking any kind of a vendor take-back note, is going to be in potential jeopardy. So, of course, they'll allow them to get a return. But the buyer has to structure his own deal, and he has to satisfy the vendor, the seller, that he is going to leave the company in good care, good financial position, and that they're going to get the same return. Private businesses get much better returns in real estate across the board. However, Brian, the volatility is significantly more, no question.
So let's talk about valuation for a second here. So you keep on talking about EBITDA multiples. Can you explain to everyone what's an EBITDA?
All right. Earnings before interest, taxes, and depreciation and amortization. The word depreciation has been replaced by amortization. So we take what we call the earnings before the interest, taxes, and depreciation. We add those back to come up with what we refer to as an EBITDA number.
So it's effectively the cash flow that the business creates before debt and before taxes.
That's correct. However, we normalize it. Very, very few company owners don't take all kinds of other benefits. 2, 3 cars, a daughter on the payroll who doesn't work there. We took some vacations. We have all these other things. So we go through a very invasive session, takes 3 to 4 hours, and say, look, you've added back all these extras. Those are income. Under a new owner, you're not going to have 4 cars for 4 daughters. You're not going to have a cabin in somewhere that you're paying all the expenses for. What is the real earnings of the business? So we drill it down to the real earnings of the business, which are not generally seen by just looking at the financial statements.
Okay, so give me a sense. Once I come up with that EBITDA, which is as I said, sort of the cash flow from the investment,
the normalized
prior to debt, and normalized before debt and before taxes. What is a typical business worth as a multiple of that cash flow?
So as we move up in terms of EBITDA, so if it's $1, $2, $3, $4 million, at $1 million of EBITDA, let's call it under $1 million of EBITDA, it's probably, honestly, around 4 times. As in general,
which is at 4 times, it means that you're earning 25% on your capital.
That's correct. And that's a low multiple. I mean, there's ways of getting from 4 to 5, but 4 times will probably be a transaction that will pay 75 to 80% of their cash up front and a payout over 2, maybe 3 years in a vendor take-back note that will be not secured, but will be next to the bank borrowing, but but ahead of any other bank borrowing or any other debt. So an owner who's selling his business, who's doing $1 million of EBITDA or less, will probably get 4 times, more than likely more. As we move into the $2 and $3 million and $4 million businesses, those multiples increase exponentially. A $2 million EBITDA deal in any decent business will probably today command somewhere between 4.8 and 5.3 times multiple. Figure it out. That's a pretty decent return for a company seller.
Okay, so why would the EBITDA multiple increase so dramatically as the size of the EBIT increases?
Because the big institutions want the bigger deals. There's greater certainty in having a business that's been around for years, doing $2 million in EBITDA or $3 million of EBITDA. They're probably more established than a smaller company. So there's a crowded market for anything over $2 million of EBITDA. That's where all these private equity firms who call us regularly saying, hey, we're coming to town. What are you working on over $2 million of EBITDA? In what sector, sir? Anything. So $2 million of EBITDA, 5 times. That's $8 million cash up front, $2 million in a vendor take back note, maybe 8 and 1 and an earn-out of some sort. Those are typical deals that we're seeing. Well, there's not enough of them.
Certainly a far more cost-effective acquisition than real estate that's trading at a 5 to 8% cap rate, which
exactly
would be a 20 to 15 times, a 15 to 20 times multiple.
But you said it first, there is a lot of volatility. It's not like real estate. No matter what happens, that shopping plaza or that commercial building is still going to stand there. And we may have lost some tenants. Tenants may have renegotiated their leases or their obligations, but the building still stands there. Companies don't necessarily remain. New competitor comes into the market, key employee leaves, key supplier says, we're not supplying you anymore. Key customer says, we don't want your product. It stinks. Companies go away.
We're chatting today with Mark Borkowski of Mercantile Mergers and Acquisitions about the marketplace, the economic marketplace, the marketplace for small businesses to buy, to sell, how you actually sell them, and comparing that to the stock market and real estate. We're going to take a break for some messages and be back in just 2 minutes with Mark Borkowski. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Tonight is my 999th show. It's unbelievable. I've been doing this for, I guess, 3 and a bit years. And Mark Borkowski is my guest tonight. Mark has been a very kind introducer to different interesting business people that I've had the pleasure of interviewing on my show. And so, Mark, thank you for that. And it's an honor for me to have you on my 999th show. It's kind of interesting. I've been chatting with this one gentleman. He's in his 80s. And he's got some assets to sell, but he's really resistant to sell. The business is his vision. It's his identity, and he enjoys the annual income from it. And if he got a whole bunch of cash, he'd have to pay tax, and I don't know if he knows what to do with it. He'd probably distribute it out to his kids, and so therefore. We've talked about this and you've got your own experiences that I'd love you to share, but it's really difficult for someone that's sort of for 40, 50 years built their whole image, their self-identity around a certain business and enjoy the trappings of that business, the annual income, the trips, the dinners, the whatnot, and actually sell. Isn't that pretty challenging? It's like giving up your baby.
It's very challenging. I mean, look, I try to get to know their future widow. I mean, I'm very good with, that's what it eventually comes down to, that many of these guys can't let go. They don't have any other hobbies. They don't have any other interests. They're not involved in much. Many of these owners, Brian, don't have any other interests. They don't have any community involvement. They live for their businesses, and so they can't give up. I'll tell you, you'd be surprised at how many of these people have net worth well in excess of what you would expect. I mean, company owners have been earning $500,000 or $750,000 from a small business with 10, 12, 14 employees don't need that next big paycheck or that next big income. They can't seem to let go. Unfortunately, many of them pass away prior to giving up, and they leave these businesses in a lurch. They ended up being sold at a significant discount because there's no transition. Most of these people as well are not doing proper tax planning. They're not doing estate planning. They're not considering the fact that there's all these benefits available for private business owners. And as simple as doing an estate plan where you spread the capital gains exemption out over the family members. I mean, these deals can be tax-free for second, third, fourth generation. The objective is that these people need to spread their income out and do proper estate and tax planning.
So two things that you mentioned, I'd like you to explain. One is the capital gains exemption. You said it was 950,000. Yes. And then the second thing you said was a rollover. Tell me about those two issues, please.
So Section 84 rollover is simply crystallizing your capital gain. So you've basically crystallized your capital gain at $950,000. If it goes up to $1 million, should the government decide that the capital gains exemption should rise, you've crystallized it at 950, and it's guaranteed to be there. It could go down to 400, could go down to $500,000. You've crystallized your gain. A very simple accounting procedure. In your company, there's been a crystallization. In other words, you've locked in your capital gain.
Locked in your capital gain exemption.
Exactly. You've locked in your capital gain exemption. I would tell you that probably 85 to 90% of small business owners have not done that, and they haven't taken that into consideration.
And you do that by way of this Section 85 rollover? That's
correct. And an accountant will structure that very simply. It's an accounting procedure. It's filed with CRA. Your capital gains exemption is locked in.
And no matter what happens. Some people are worried that a future government may reduce the capital gains exemption. Is that something you're concerned about?
I've been concerned about that for the past 11 or 12 years. Every year it's been challenged. Frankly, though, every year it's gone up. I mean, it was at $900,000 at the end of last year, and they've now bumped it up to $950,000. The trend in the U.S. has been to reduce it. When Ronald Reagan brought in their small business capital gains exemption, it was intended again that business owners would reinvest capital once they cashed out into other ventures. That didn't turn out. So they scrapped it for the most part. Canada's kept it and has kept it going now for the last almost 17 years, 18 years. However, it's a very, very big expense to the Canadian government. There's estimated in the multiple of billions of dollars, the impact, and there's no positive impact to the economy. Many of these business owners who do cash out tax-free end up buying boats, cars, and vacation properties, and they're not investing back in
so that's
businesses.
I don't think that's fair, that there's no economic benefit. So the rationale for it is that what it does is it gives people an incentive to actually invest. If they didn't think that they could invest and get that capital gains exemption, ultimately when they exited, the logic is that they may not be as interested in investing.
Well, that's possible, and many do reinvest. Back in other businesses, they become angel investors. They invest in other people's businesses. They invest in other family members' businesses. But the vast majority take their capital gains and put it into personal ventures, as I say, vacation properties, vacations, boats, cars, etc. So the small business capital gains exemption is potentially in jeopardy somewhere down the road. And it's been studied now every single year as to whether it should be reduced or just eliminated. But again, every year it's been bumped up. So we'll see. So
your argument is that you can get higher returns in investing in private businesses. You think that you've got the benefit of a better tax situation. You've got the capital gains tax exemption. So why don't more people do it?
That's the issue. I mean, again, there's how many businesses are there, private businesses out there, relative to how much real estate is out there. The
There's
amount of
thousands every up and down every street are little retail shops. In every industrial park, there's tons of little businesses. I'm astounded at how many small and medium-sized businesses there are.
There are many. It's much more real estate. Again, for all of that large number of small businesses, not that many are prepared to sell real estate transactions frequently. It seems to transact much more frequently. So a lot of these small business owners are owned by people who do have a transition, who will turn it over to a son or a daughter or to another family member or to an employee. So there's not that many companies that actually come up for sale. But there's a limited number,
Let me ask
large or small.
Let me ask you a question, Mark. I had a really interesting conversation with an economist who said part of the problem with our very low interest rate policy over the course of the last, 2 decades, and our lack of supply of housing meant that it was really easy to make money in the real estate business, particularly buying, pre-construction condos and then renting them out, and that a whole bunch of people got involved in investing in 1, 2, 3, 4, 5, 6, 7 pre-construction condos or other properties that they would end up becoming landlords in and rental of. And he said an interesting thing. He said, really what it's done is it's attracted a whole bunch of capital out of the stock market or out of private businesses that are far more productive. And one of the reasons why we have this productivity challenge versus the United States is because capital has gone to the real estate, both debt capital as well as equity capital has gone to the real estate business and not into the more productive parts of the economy, which is small and medium-sized businesses. What do you think of that?
But that's changing. Money, as I say, the institutions right now, the pension plans, Canada Pension Plan, are appropriating a greater portion of their capital into supporting private business, and they're doing it through investing in private equity funds. Private equity funds are the managers that go out and make these acquisitions or make these investments and then manage these investments. The large institutions don't have that capability. They don't have the staff, the resources to do that. So on a percentage basis, over the last 4 or 5 years, you've seen that the percentage of what Canada Pension Plan, for example, has appropriated to private equity has almost doubled. And it's going to double again over the next 2 or 3 years, because that's where the returns are. And that's where the productive economy is growing. It's not growing in real estate. Stock markets are languishing, I suppose. I'll tell you another trend that we're seeing. And, this is just from the perch where I sit. Smart money, and we refer to smart money, the big funds, are migrating back into cash. That gives us an indicator that there are bad times potentially, dark clouds ahead. When people are sitting on cash and not investing, that tells us that there are potentially bad times ahead. And, people who have cash in bad times do much better than people with cash in good times.
Well, let's talk about that for a second. So I've been at 2 conferences recently, one a real estate conference and another an economics conference. And both of them were a little bit discouraging. They talked about interest rates staying higher longer than most people thought. And there was a backup in the long-term portion of the bond market about 2 weeks ago, which says that the market was finally saying that that's true, that interest rates are going to stay higher longer, that while inflation has come down, it hasn't come down fast enough and internationally enough such that central banks can really reduce interest rates. They may not have to keep increasing interest rates, but they may not reduce. And one of the individuals commented, that it's really difficult to have an independent monetary policy, that if the United States inflation hasn't come down, so that therefore interest rates in the United States aren't going to come down, Canada doesn't have a lot of flexibility. Otherwise, what we'll do is if we reduce interest rates, our Canadian dollar goes down, and our import costs go up, and we import inflation from the United States. So therefore, it's the opposite of a self, defining prophecy. It's a self-reinforcing inflation segment that we've got to keep interest rates comparable to the United States until their inflation rate goes down, and therefore their interest rates go down. Several different economists were saying that expectations of a mild recession have gone up. that unemployment is now a little bit higher. Banks, just in the last 2 weeks, have been laying people off. Wealth management companies have been laying people off. Real estate brokerages are not making a lot of money because the real estate market has declined. There's a lot of sort of negative clouds on the economic horizon.
You say mild recession. Smart money's talking about something stronger than that. We're seeing a down cycle. Yes, the banks have overhired. Yes, the wealth managers have overhired. I mean, Bank of Nova Scotia announced a 2% reduction. Actually, in reality, it's going to be more like a 3% reduction internationally, maybe as high as 4%. So there is something coming. However, I can tell you unequivocally that private businesses are still in great demand. There's a shortage of opportunities. The banks are prepared to fund. The private equities are crawling all over each other and us and me, looking for opportunities to invest, because returns in small and private business are substantially better, have been, and will continue to be, than any real estate. We can't speak for public stock, but relative to real estate and current cap rates, invest your money in private business, Brian. Let's go buy something. Not a lot to buy.
You got to come to me with what that opportunity is. I'll be happy to look at it. But
let's have a look.
Let's you and I talked about Evergrande,
yes,
Chinese real estate company that has effectively gone bankrupt, and has some real challenges. Commercial real estate in China, residential real estate in China, bank loans in China are in terrible shape. Charlie Munger, Warren Buffett's main guy, is saying his biggest concern is regional banks in the United States because of commercial real estate lending. You don't think any of that contagion from China or the United States is going to come to Canada?
Of course, that contagion is coming to Canada, but it's in real estate. It's not affecting small business. It's not affecting manufacturers or distributors of service organizations here. It may affect interest rates. However, again, it's a whole separate world. It's real estate. We're private business. We're strong and getting stronger. And capital is flowing to us, maybe not flowing to real estate. But let me tell you, and listen, if it wasn't for BDC, we would have a big setback in Canada. BDC is a strong supporter of Canadian business. They bend over backwards to help a lot of these companies under 10 million or greater in revenue. They've made a big contribution. All the major banks right now have small groups out there knocking on doors, looking at loading these companies up with more debt, because private businesses will return greater returns.
Okay, so give me some examples of the private businesses that you think people should look at. Are we talking about franchises?
No. So no franchises. By the time most franchise owners pay the franchise fee, there's very little left over other than a salary. Stay clear of everything in the hospitality industry at the present time. I have a colleague who has been in my business probably not as long as I, who tells me that there are probably close to 300 to maybe 375 restaurants in the Toronto area alone that he's aware of that would sell today. He did a transaction back in July where the restaurant was sold for $2. And the new owner took over the obligations and the lease and some of the other obligations to allow the owner to drift off into the sunset. No hospitality. The service industry is very hot. Manufacturing is in great demand. Anybody manufacturing anything in a value-added fashion will have multiple offers from a large number of groups. And I'm not talking just about Americans, the Europeans, the Canadians. However, it requires someone like me to reach out. So when we're divesting of a company that might be doing $2 million in revenue, to make sure that we've met or contacted the ideal buyer, we buy data. So we have a list of information, which is very expensive, but we'll reach out internationally to the logical buyers. If we're selling a company that manufactures frames for glasses, we'll reach out to 400, maybe 500 companies worldwide and get in touch with the CEO, CFO of those companies that we know exactly who's in that business. The objective is to bring the best fit, to give the owner the greatest deal possible, greatest cash, and also to bring an organization into the market that's going to add more value than currently is. We discourage those organizations that are being sold to a leveraged buyer, where they've loaded the company up with a lot of debt. The company was doing $10 million this year, and 4 years from now will be doing $11 million because they have no capital to grow. So I discourage those deals, as many of my colleagues do. That trend is going away. Sellers don't want to sell to owners who are going to load their company up with a lot of debt, keep their employees sort of in the same positions as opposed to growing those organizations. However, there's a lot of money available to do deals of any sort.
And if people want to reach out to you to take a look at deals, do you offer that service, or no?
Absolutely.
Or do you want to just act for the vendors?
We want to hear from everybody. There's a lot of wealthy individuals who've come into the market, people who have sold a big business, who bring a lot of expertise into the market. It's not about the money that they bring. What we're really interested in are people who understand how to run a business. We refer to those people as the operators. That's the scarcest supply. Lots of money, a good supply of companies, very limited number of capable operators. A lot of the people that come looking to acquire a business have no capability of running that business, so we discount them. There's no point carrying on.
Why don't you have enough operators?
Well, listen, if the guy has no background in having run a business but inherited a great deal of money or got some kind of a windfall, the likelihood that he's going to step into a CEO's position or a company president's position running a company of 50, 60, 100 people, there's no hope for success. He may be able to acquire the business, but will he or she be able to run it successfully? Probably not.
We're chatting tonight with Mark Borkowski of Mercantile Mergers and Acquisitions about the M&A marketplace, the private equity marketplace, the entrepreneurial marketplace, the opportunity to get in there and buy a company, and not a huge company, a company that, as he's described, might have $1 million, $2 million in EBITDA cash flow, and so therefore it's worth $4, $5, $6, $7, $8, $9, $10 million, and you can leverage that up with some bank debt. Sounds like a fascinating proposition. We're going to take a break and come back in 2 minutes with some concluding comments with Mark Borkowski, Mercantile M&A. Stay with us, everybody. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. As I've told you already, this is my 999th show, and it's a real honor to have Mark Borkowski, the president and founder of Mercantile M&A, Mergers and Acquisitions, as my guest tonight. He's been a big supporter of my show, and I really appreciate that, Mark. You've introduced me to some really fascinating companies and some interesting individuals. So thank you for that.
Thank you.
We talked about buying companies, but not everyone can buy a company. Is there still an opportunity in Canada for entrepreneurship and startups?
Absolutely. Go, if you can't acquire a business because you don't have the capital, go start something. Unfortunately, most of these individuals who have this entrepreneurial desire, and there are many, we're inundated by people who reach out, who just don't have the wherewithal, but go and contemplate starting something. Go do some research, go find a niche. Frankly, it's a limitless number of private investors that want to partner with these people, that will support them, the independent sponsors. So if you've come up with a very good idea or very good thought to put something together, I can think of a dozen people who say, look, I'd love to get involved with that individual. I've sold my business. I used to be in that business. I would love to partner with a really strong, capable guy. But that individual who's starting the business has to have some skin in the game. Those individuals are looking to get something for nothing, no point. Great opportunities because the BDC is there. If you're coming to the market and saying, look, I'm looking for venture capital and I want somebody to put $5 million into my business, very unlikely. Hard deals to do. Think big, start small. Start a business out of your living room. There are people who will support you. There are angel investors. There are mentors. I love to hear from people that are starting something. I get excited about going to their homes, having them come to my office to say, look, how are you doing? Have you put all the pieces into place? Usually, a lot of these startups need 3 things. The guy who's going to operate the business, he's either a salesman or the individual who's going to do the technical part of the business, somebody who's going to call it the accounting, finance, and administration. And that individual, as I say, who's either the technical individual or the sales individual. So sometimes three people who come together are all three accountants. The likelihood that they're going to make anything successful, because nobody's selling, nobody's building something. So individuals that come together in a group of three or a group of two, but have all those skill sets, very unlikely are going to fail. And we counsel them that way. There's money available to support these individuals as long as they put some of their own skin in the game. And it could be as little as $50,000.
Mark, I got to tell you two stories if I could. There's probably a lot more that you could tell me, but I used to work for Jim Pattison. Jim Pattison in the 1950s, 1960s started with one car dealership.
Yes.
And then he noticed that he had room for a big billboard. And he erected a billboard, and he started renting it out to Overweighty Foods, which was a local grocery chain. And he found that he could make a really good business of renting out those billboards. And Overweighty Foods became available. He bought Overweighty Foods, and then he bought the billboard company, and then he bought more and more and more companies. And all those companies were really small and medium-sized businesses. It wasn't a big conglomerate. I had the privilege of working for the Walt Disney Company and Molson's. Both of those were really big companies. But Jimmy got his start in a small business, and he grew it, and he took the money out and bought another small business and grew it and took the money out and invested in another small business. And today he's probably worth close to $10 billion. And
he's 94 years of age. And I heard him speak about a month ago. He can't wait to get up in the morning to go to work. Honestly, he's 94. And somebody asked him in the interview, why are you not retiring? He said, well, I owe the banks too much money. I can't slow down. Listen, no guts, no glory. Go start something. If you can't acquire a business, go start something.
I worked for a guy by the name of Eugene Melnick.
What a great man.
Who quit college and started selling knickknacks to companies, promotional stuff to companies, and made a good business of selling, things like coffee cups with logos on them and stuff like that. And he ended up selling that company for $8 million. So he built it up and sold it for $8 million, probably comparable to a lot of the companies that you're buying or selling. And he took that $8 million and invested it in a pharmaceutical company, a specialty pharmaceutical company, and grew that to $5 billion. And then he wanted to get in hockey, and he bought a company by the name of the Ottawa Senators NHL hockey team for $126 million, $80 million US. And that was sold by his estate recently for $1 billion Canadian. So he turned 126 million into $1 billion. And in 2003, when he bought that, people can't think back that long, maybe, but hockey was out of favor, and hockey teams were out of favor. It was an international marketing of the opportunity to invest in the Ottawa Senators. Only two people bid. And the whole team went for $80 million US, which was the same amount that a franchise sold for a couple of years previously. So arguably he got the arena, the team, the sticks, the goalie pads, the whole management and team for free. He only paid.
But Brian, you helped them get there. You were CFO of the Ottawa Senators. You were part of Melnick's campaign at BioVale. A big part of his success was your success. So don't be too humble.
Thank you. But you know what? He was the guy, and Jim Pattison was the guy that took the guts to invest in business. And I think you're right. It takes a special entrepreneurial desire, passion, flair. But lots of us have got it, and lots of us should have it. And I think that's where you actually add to the productive economy. I had the privilege recently of going to my 35th reunion at Harvard Business School. And you know what? There were some people on Wall Street that were happy. Some people that worked for big consulting companies were happy. But the people that actually sort of had the most passion were those people that had worked in companies or been entrepreneurs and built things up of lasting value.
Amen. No guts, no glory.
Mark Borkowski, Mercantile Mergers and Acquisitions. Thank you so much for joining us.
Thank you, Brian.
That's my show for tonight, everybody. Thank you again for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and video casts are available on my website, briancrombie.com. I publish my podcasts on Audible, Apple, Speakeasy, SoundCloud, etc. And my videos I post on YouTube, on Instagram, on Facebook, on LinkedIn, etc. I try to get out in as many ways as possible. I'm told I get 25,000 people a night that are listening to me. It's a real pleasure. It has been an incredible pleasure for me to interview some fascinating people over the last 3.5 years that I've been doing the show, to have the opportunity to express my own views on a repeated basis. I try every once in a while, not all the time, but every once in a while, to end my shows with 5 minutes or so of my own little rant on my own opinions on the topic. But it's really been an incredible pleasure meeting all of you and sharing my thoughts, my ideas, my friends, my associates, my interviewees with all of you. Hopefully you enjoy it. And please check out my interviews on briancrombie.com or on my social media platforms. That's our show for tonight.
Number 1,000. Waiting for 1,000.
John Tory, former mayor of Toronto, tomorrow night.
Excellent. Thank you.
Good night, everybody.
Bye.